Morning, Michelle, and thanks very much for joining us on Blue Notes for the full year result. Can we start off by talking us through the capital and why that's important for the components of the bank's balance sheet and the robustness of the bank?
Sure, and Andrew, it'd be nice to, hopefully we get to see you in person sometime soon. Capital is really important at a time like this. Essentially what it does is it gives us capacity to absorb potential future losses that might come. And the way I think about it is you've got to look at the starting point. So as we sit here today, our capital position's really strong. We talk about ratios, it's 11.4%, sort of pro forma. And what that means is essentially we've got nearly $4 billion more than what the regulator says is the minimum. And then on top of that, we've got about $5 billion in collective provision charges. So that's money we've put away for losses that might come in the future. That gives us quite a lot of capacity because, the world is still uncertain and, we don't know exactly what's going to come. On top of that, we continue to add to that capacity. So as we go into next year, we'll continue to generate profits and those profits add to those capital levels. So all of that means is, while the things are still uncertain, we feel like we're in a really strong position to be able to deal with them going forward.
Well, it looks like it won't be too long before we can see one another in person, Michelle, so hopefully that continues. But it is, as you say, a different world. So how are you balancing that prudence that you're talking about with the need to allocate capital and use that capital efficiently?
Yeah, it's a really good question. The way we've approached it is to really think about them together, not as an either or. So if I go back to the start of the year, no one knew what this crisis would look like. At that point in time, many of our customers didn't know if there'd be a liquidity crisis because that actually can be a big issue when there are economic stresses. And so we had quite a lot of our customers want our support in terms of access to liquidity, which we were able to work through with them. And because we didn't know how the stress would evolve, we thought the right thing to do at that time was take a really prudent approach to the dividend, and we deferred the decision on the interim dividend. That was prudent, but it was also the most efficient thing to do in terms of the value outcome for our shareholders as well. As the year's gone on, actually the liquidity dynamics changed, so those customers didn't need that support, and we were able to manage our capital to effectively build our capital reserves just through sort of working that through. And so with that enabled us when we got to August to actually declare an interim dividend, and has again given us confidence to declare a final dividend today. So we sort of worked through it to keep our balance sheet safe, but as we made our decisions on dividends and how we used our capital, we were really conscious of doing that as efficiently as we could for our shareholders.
The other element here that is a sort of ongoing force is pressure on interest margins, particularly from the sort of lower global interest rates. How are you managing those margin pressures?
Yeah, and you touch on lower rates. Lower rates is potentially a benefit to losses because we've just been speaking about losses that might come. But yes, you're right, they do impact on revenue. And that is a pressure the whole industry is working through right now. And it was quite a big factor in the result actually, with our margins down quite a bit in the half. There were some other drivers of margin. So we had some of the choices our customers were making this year in terms of which customers wanted to grow and which customers were probably a bit more cautious. The growth was probably more in those lower margin type parts of the business. On top of that, we grew our deposits really strongly, and that's a good thing. But in a way, because our customers, the demand from our customers, didn't grow as fast as that, that also causes a headwind to margins. So how do we deal with that? the way we deal with it is, as always, we manage our capital allocation to, think about our risk-adjusted returns. But we also try to manage the cost of our funding and the composition of our funding to at least sort of minimise some of those impacts. But the way we think about this is much broader than just margins, actually. And if you look at our result, our revenue performance was pretty much flat year on year. And so while margins caused us some pressure, we did grow in some parts of the business, and we had strong performance, for example, in our institutional markets business, which is a little bit of a natural hedge to some of the pressures and stresses we feel elsewhere. So we look at it sort of quite holistically. And then the other thing I think we've been really good at managing, and I'm sure we'll get into a bit later, is costs. Because managing your productivity is also really important to offset some of those pressures.
Well, if we look at costs then, how are you balancing cost management with that higher investment spend that's going on?
Yeah, I think we do a really good job of that. Every year for the last 4 years, I think we've managed our costs in an absolute sense really, really well. And within that, we've been increasing our investment. So this year, for example, we reduced our, what I'd call business as usual, run the bank costs by pretty much the same amount as we increased our investment spend by. And that's after inflation and everything. So really, really good outcome. And some of what we'd been working on in previous years, we've started to get the benefits come through this year. Some of our simplification of our processes, some of the rationalisation we'd been doing on property. So we'd been working through some of it for a time. But COVID also accelerated some changes in our customer preferences, which actually led to us being able to interact with our customers more through digital channels, which also helped us on costs.
And just finally then, ANZ is now looking for a better than expected, or perhaps a less worse outcome from COVID, but the recovery will be slower. Is that changing priorities?
When we were sitting here, I was talking to you 6 months ago, we were looking at a pretty sharp, severe economic impact. So we had 13% trough fall in GDP, 13% peak unemployment. As we sit here today, that clearly didn't happen in 2020, but we are forecasting a slightly longer recovery. And so, for example, we're forecasting unemployment to stay a bit higher for longer. What does that mean? As we look at different parts of our business, starting maybe with the institutional business, which is our bigger customers, they are more impacted by the short, sharp impact and retail and sort of smaller customers probably are more impacted by a longer period of unemployment. At the same time, we've been doing a lot of work on both groups of customers. So at the bigger end of town, you pretty much review every customer one by one. And actually, as we've gone through that, we feel pretty good about where they're sitting, probably better than we did 6 months ago. Where we feel more of the stress is going to be is probably around some of our smaller business customers, and particularly some of those in some geographies or some segments.
Thanks again very much for your time, and hopefully it won't be too long before we see one another. Thanks, Michelle.
Thanks, Andrew.